Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today we are lucky to have Michael Oliver, founder and chief analyst at Momentum Structural Analysis with us. Love to have him on the channel. So I'm thankful that he came on. So thank you for coming on, Michael. Really appreciate it.
Good to be here, Andy.
Yep. So tell us a little bit about your background and kind of how you evaluate markets, just to kind of give us a framework of how you approach the markets.
Well, I started out sort of as a kid. I was working on a PhD in political philosophy, and I quit. This is in the great stagflation period, mid-'70s. And I had a political background that wasn't going to get me very far in the university system, so I was a libertarian back then. And a friend of mine joined Merrill Lynch as a commodity broker, and he said, "Come on in, the water's fine," as a potential career. And so I checked around and I got hired by E.F. Hutton in New York, their headquarters commodity division. The chairman of that department at Hutton, which then was the second biggest commodity firm in the world, futures firm. He was also chairman of the COMEX. And this is the year 1975 when gold was legalized and began trading on the COMEX floor. Back then, the COMEX was on Broad Street, a couple blocks or so, a block or so from the New York Stock Exchange. Later on, it moved to World Trade Center, but in the early years, that's where it was, in its own building. They traded copper, silver, and then they added gold. When gold started trading in 1975, that in fact was a peak, because it had been running up in the cash market from the low 30s up to $200 by the time it opened for trading. In early 75, it was already at 200. The bull market was over since it opened. Okay, so it basically peaked then. Went down for the next year and a half, but I was in New York for a year and a half with Hutton, and I knew nothing about technical analysis. I knew a lot about gold, and that's one of the reasons I got hired, because I was going to be a gold specialist. But I didn't know anything about trading as such, or technical analysis. And my boss, David Johnston, was an orthodox technician, which he price charts, in other words. And he coursed me in that, part of my apprenticeship. So I learned about price chart analysis. So back then you did it by hand, by the way. You didn't have Excel spreadsheets, okay? So I learned over time that price chart analysis, which everybody used, everybody was a technician, meant they were price chart analysts. Everybody's looking at the same thing. I think Joe Granville once said, if everybody sees it, it's probably not true. If everybody believes it, it's probably not true. Anyway, everybody's looking at the same price charts, and they have the same orthodoxy, like, a head and shoulder pattern, a saucer bottom, all these things that everybody knows. And so if it's obvious to everybody. Well, there's something wrong with that. Because if everybody knows it, then it's fully priced in, because everybody's going to be long. Okay, so and if they're wrong, oh boy, it's a disaster. Anyway, over time, I played around with what I call momentum analysis, different from the tools you have on your computer screen, free tool like the RSI, Relative Strength Index, or MACD. These are common, what I call wet noodle indicators. In fact, they look like wet noodles when you see them on your screen. What I did is I used to plot the daily bars or the weekly bars of a given market. Instead of on a price scale, the scale would be an oscillator with a zero line, and the zero line would be a given moving average. Let's say a 3/4 moving average. And I would plot each monthly bar of, let's say, the S&P 500 in relationship to that zero line. So either you're above the zero line, meaning you're above the 3/4 average, or you're below it, and you plot those bars accordingly: high, low, close, high, low, close. You get a different bar chart picture when you do that, using the moving average not just as an overlay on the price chart, but as a axis line. Okay, so the market is trading around that mean, and it develops a different chart picture than it does when you look at a price chart. And I found over time, and I'll say this with high level of conviction, 90+% of the time, momentum will warn you more clearly and ahead of time that a top is being made or a bottom is being made before you can see the evidence on a price chart. And so if nothing else, it gives you a warning. It also gives you structural breakage points where, just like on a price chart where you might draw a trend line, let's say ascending lows, so you get an uptrend or a flat floor. Do the same with the momentum chart. But invariably, that momentum chart is going to break that structure before price does, if price even has such a structure. So usually trend changes are more obvious on momentum, and they come earlier than a price chart breakage. By the time the price chart breaks, momentum's already spoken. Hopefully you already have your position, and then the mob comes in. Why? Because their price chart broke down 2 weeks after momentum did, or 2 months after, and they join in. So it usually puts you ahead of the game. We also, at MSA, Momentum Structural Analysis, we analyze different timescales, because there's big trends and there's little trends within the big trends. So right now, for example, the S&P is rallying. Okay, when you go down and look at its weekly momentum charts, this is in our weekend report, we caution that, yeah, you're in a rally phase on weekly time scale, where you measure versus, for example, a 3-week moving average. You plot the bars in relation to that. You're in an uptrend. But in the context of the bigger picture, that weekly upside is opposite. It's counter trend to the annual momentum trend, which is highly negative. It only turned negative back for the S&P back in February of last year. And for the NASDAQ 100, it turned negative by our metrics in January of last year. Those sell points were about a month or two off the price highs, actually, where annual momentum said, it's over. Okay. So you've got to, if you're looking at any given market, you've got to decide, what's your time frame? What are you looking for? Are you looking for a trade that might last, a couple weeks? Fine. Okay. If that's your time scale, live with that. Measure that market via metrics that are fairly short term, because that's what you're looking for. It's a short term move. It doesn't really matter to you that the annual trend is negative and yet you're buying it, because you're in there for a scalp, trying to take some money out of the counter trend rally. But if your framework is that of an investor, and you're thinking, where I want to hold something for the next year, next several quarters at least, then your time frame should be longer term metrics, measuring the market versus a 36-month average, like a 3-year average, 3-quarter average, something on that time scale, something bigger. So you as the trader or an investor have to decide, what is it you're in this for? Scalping or investing? And then
when you take your trades, when you look at and evaluate something, how do you evaluate it? Do you take a bigger picture view? Do you do the long, short term? Are you trying to time the short term market? Do you take a bigger, longer view?
At MSA, our reports generally focus on what we would call intermediate to long term, although we do look at short term sometimes, because we want to caution our investors that and our subscribers are all primarily institutional. In fact, we didn't open up to retail subscribers until late 2015. We started in 1992. So for the first couple of decades, we were strictly institutional, meaning hedge funds, mutual funds, banks, and so forth. So each of our clients are different. Some of them are fairly short term in their outlook, or intermediate term. But generally, we orient our analysis toward the longer term down to the intermediate term. Meaning, by intermediate, I mean what's going to happen over the next couple of months. Okay. So, and we try to fit those together. So we sometimes, again, the intermediate might be up while the long term's down. But that's our time. That's our time frame, is generally more of an investment point of view.
Have you seen any confluence of timing? I mean, that's probably the ultimate, is when you get a long-term indicator, an intermediate, and a short-term all align for a bottom.
Yeah.
Like, that is the entry point that everyone, I think, probably looks for. Have you seen any of that alignment over the past couple of years, like commodities, the overall market? And I would assume that some markets are bottoming at the same time that other ones are topping. So
yeah,
what have you seen kind of in the markets right now with your momentum analysis on what's bottoming, what's topping, what looks good, what looks bad?
Well, we're in a unique situation right now, and I say that with my years of experience of having seen all kinds of market tops and bottoms, the stock market, commodity market, so forth. Quite often they're in sync with each other. Sometimes they're not. Okay. And a lot of people make certain assumptions about the synchronicity of given markets. For instance, a very common belief is that as goes the dollar, so will opposite go the gold. That's simply not true. Yes, since March of last year, as the dollar went up, gold went down up to a point. Then the dollar peaked and has come down hard recently in the last few months, and gold has rallied hard. So there is an inverse relationship there. But when you go back over time, you'll see that that relationship is quite loose. In fact, it's almost so loose you can't call it a correlation, even an inverse correlation. So that linkage that you're talking about of what markets are doing is sometimes the effect, it can change over time. A recent example of very painful for most investors last year, the 60-40 rule. 60% of your money is in stocks, 40% in bonds. You've got a balanced portfolio, meaning you protected yourself. If the stocks get kicked, you've got bonds. Well, last year the bonds went down more than stocks did even. So you got killed on both sides of the equation. All paper assets, which had been inflated, artificially priced to the upside for a dozen years since the 2009 bear low, by the central bank policies, repeated over and over inflationary monetary expansion policies, drove that asset grouping up, drove bond yields down, drove the stock market up, drove municipal bonds up, high yield corporate debt went up. All these paper assets went up together. When they broke, they all broke together. In fact, T-bonds were already negative before the stock market turned negative by our metrics. But in January of 2022, the NASDAQ 100, which is the leader index. What do I mean by that? If you could look back at the last dozen years from 2009 to 2021, dozen-year bull trend, longest bull trend in U.S. market history, also the biggest percent gain. NASDAQ went up 16-fold in that dozen years. S&P went up 7-fold. And even the S&P 7-fold move beat the pants off of any prior bull market in history. Even the 1929 bull was only like a triple. The dot-com bubble, that bull was only like a triple to a quadruple. The 2007 peak versus the 2002 low was a double, yet we had a massive bear market afterwards. Here you've broken a bubble, the Fed has, through a policy shift. They've broken their own bubble, and all these paper assets are going down together. So there's a synchronicity there. But at the same time, now a lot of people make the assumption that commodities will go with stocks. And there have been times in past where you can see, well, commodities are going up and gold's going up with the stock market. And then there are times they totally divorce. For example, from 2000 to 2011, gold went up about an 8-fold bull move. Okay. From the 2009 low, stock market went up. So between 2009 and 2011, both stocks and the gold were going up together. And then gold peaked and went down, stocks continued up. So there was a synchronicity, then a total opposite. So it can shift. A lot of people were fearful that if the stock market breaks and we go into recession or depression, it's more likely in my view, that it will drag down commodities because commodities will be dragged down by a recession. The problem is if you stand back and look at commodities, go back the Bloomberg Commodity Index, go back 20 years or so, or take the CRB index. Yeah, we've had a major percentage increase since late 2020. MSA called for what we call the commodity explosion in our October 2020 report. At that point, the Bloomberg Commodity Index was trading around 70. Between then and early 2021, it went to 140, it doubled. But even then, even with the doubling in price of the Bloomberg, its price level was still way below its 2008 peak. So yes, you did have a big percent gain year over year inflation, quote unquote. Very narrow definition of inflation, by the way, just to look at commodities. Stock market had a heck of an inflationary bubble, okay? And it's now broken. But commodities are still relatively cheap. If you go back and look over the decades, look at the Bloomberg, where it is now, trading, 110 area, 109. It's a pullback from the 140 high. and compare it to prior price peaks, it's not up there. It's only halfway up to some of these old peaks. So yeah, on a year over year basis, there's, quote, a lot of commodity inflation, but on a historical price level, commodity prices still are not that expensive. Some of them are. Crude oil went back to some highs, but a lot of them haven't. What was interesting about that commodity explosion was it occurred in virtually every single commodity at once, which tells you that it's not a specific commodity situation, like a drought affecting wheat, or some specific thing affecting only oil. Everything went up at the same time. So it was in harmony. So it was something else. And I think what the something else was is this. There are a lot of asset managers out there, big fund managers, who perceived that the stock market was overvalued over the last couple of years. They knew what drove it up. They knew that the central bank was a major factor. And there's a point at which you go too far with that. And they were starting to sense that, hey, this asset category, the risk reward here is not so good anymore. And therefore, they began probably, and I think this is the case, began to slightly shift out of that asset category into something safer, such as commodity stocks, which had not participated in much of that stock market bubble. In fact, if you look at the XLE, the energy sector ETF, during much of that bull market in stocks, XLE was going down. Oil was under pressure, so were the oil stocks. So it didn't correlate well. So it was no surprise to us that in summer to fall of 2020, we started calling for buying of fertilizer stocks, which were off the page beat up at theoretical zero price levels. We weren't going any lower, they needed an excuse to go up. And energy stocks. And sure enough, now those are very popular items, over the last year. It's a little late to be joining in, by the way, in our view. But they exploded while the stock market was under pressure last year. So you'll notice the energy sector beat the pants off the S&P last year, naturally. And commodity stocks in general, copper producers and so forth. And we think that'll likely continue because we think there's another leg up, at least one more leg up in the commodity boom. We've had the first one, just the first leg. And this was an annual momentum upturn for commodities. It wasn't something we based on weekly action or month to month. It was based on where is price in relation to the 36-month average. How did it look on a momentum chart? And it was clearly breaking out of a major base in late 2020. Price got the message only halfway up the explosion. Price charts got the message. But at that point, everything commodity related just lifted off. And annual momentum trends tend to last several years, sometimes a decade. This has only had one leg up. That's the leg that from late 2020 to the high in early last year. We expect to see another up leg at least. And we think what we're in now in the commodity sector, and this applies to commodity stocks as well, is a corrective process, not a downturn that's going to sustain, regardless of the argument that's very popular, though we're going into a recession, therefore it's going to hurt commodities. Commodities are still vastly underpriced. They will be a better place to be. And stocks related there too. So that's one category we really like.
Yeah, and looking at specific sectors, actually I have a whole bunch of questions now that it rolls off. So we've got this in the increasing interest rates. We broke through that downtrend line. I'm guessing the momentum has shifted on interest rates to maybe a potential new paradigm shift environment, which is going to be, I think, a game changer in, we'll say, the overall markets and bond market. And all that money is going to have to shift somewhere different now. Would you agree with that, or?
Yeah, it is, and I think that a lot of asset managers have learned a hard lesson, and investors are starting to learn. The bond market right now is trying to rally, meaning yields are trying to dip back down, and we think that might persist for a couple months. So don't be fooled by it. Yes, the breakage in the bond market, price to the downside, yields to the upside, that has occurred over the last year, had a lot of follow through once it broke. Once momentum broke in structure, you had a real collapse in price. And it got to a level that we thought might be a bounce point. And sure enough, it got there, got a point or two below our target, and it's since gelled and started to bounce. We think that bounce effort will probably persist for another month or two. And it'll fool a lot of people into thinking, well, we've seen the peak in rates and so forth. For a while, you've seen the peak in rates, but don't count on it sustaining for, over the next couple of years. So that we view as a counter trend bounce in the bonds, drop in yields. Stock market, we don't think has paid its dues at all. We think it's just had its first leg down. You'll notice if you look at most of the price charts, go back to the June low and draw a line across, you'll see that the S&P is above that low, Dow's above that low, but the NASDAQ is trading either side of that low. After all these months of buying and buying and buying, these rallies, and small caps as well, Russell 2000. Go to the June low, draw a line horizontally. You're trading either side of that line. You're hardly off the June low, and yet look at the number of months that have gone by since the June low, and yet no sustainable rally, despite all the money pouring in saying it's bottom, it's a bottom, it's a bottom. And we think that will fail. We think later this year, the S&P could drop down to 2,700. Right now, you're trading 3,900, so that's a pretty big further drop. NASDAQ, we think, could drop down to under 2,000. Anyway, so the leadership on the downside now is the NASDAQ 100. It led the upside in percentage basis. Now it has led the downside on a percentage basis. And so our focus is on that index primarily, not the illusions and delusions we get from the Dow Industrials, which has not been punished as badly as the leadership index, because the leadership index is heavily weighted with large tech stocks, Microsoft, Amazon, Apple. We look at those three stocks in particular, and by our metrics, yes, they've been down pretty good this year from where we called the downturn, but they've broken so much other momentum structure freshly, and they're not at all oversold. When you look at long-term momentum charts, you think, gee, this market's got to be oversold. You want to look at a weekly, maybe so. When you go to an annual momentum chart, you've got a long way to go to reach what you could call an oversold status. So we think the bear market is underway. It'll last probably during 2023, at least. And we think the real world consequences, I'm talking about the man in the street type consequences, the unemployment, the cost of beef, all these type of day-to-day human pain things, their debt to income ratio, all these things are going to be far worse than it was in 2009. This bubble is far bigger. Its breakage will be much deeper and have more real world consequences than even the 2009 breakage did. So expect there to be ramifications beyond the markets. I'm not the only one saying this. Nouriel Rubini.
I was going to ask you a quick question here.
Go ahead.
Do you think it's going to be an inflationary recession, or how that
it will be? It will be to the extent that the inflation won't go where the Fed wants it to, meaning they're going to have to defend certain key assets, muni bonds, high yield corporate debt, just as they did in 2008 and 9, which didn't stop that breaking bubble, the mortgage-backed security market. They came in spring of 2020 and outright bought muni bond ETFs and high yield corporate debt ETFs. They outright bought the same thing that investors were buying, drove those markets back up. In other words, added more to their existing bubble. They added more to it. When they ceased buying those markets, high yield corporate debt like HYG or JNK, the ETFs, or MUB, the muni bond ETF, go back and look where they peaked. Those markets peaked before the stock market by a handful of months. Why? The Fed quit buying them in the summer of 2021. And as soon as they quit buying them, those markets went back down, which tells you what? The only reason they went up is the Fed bought them in the first place. So ultimately, the central bank will have to come back in to defend certain institutions, including the US government bond market and state and government debt and high yield corporate debt. Otherwise, they're going to have real world consequences that will be off their heads. Nouriel Rubini is a generally associated with Democrats. He's come up with the same conclusion, that this is different than any other breakage we've seen. This is not 2009. It's going to be far worse, and there will be social in the street type consequences. Because the domino effect here is going to be way beyond just hurting people in the stock market. And therefore, I think there will be political disorder. And we know we've got divide in this country, but you're seeing it globally. You're seeing in certain countries in Europe, political parties rising up that have never been dominant parties before and winning, taking power. Parties that, for example, don't want to be part of the EU anymore. You're seeing the type of thing in Brazil, where you have a major global economy and they're politically split, just as we are. And I don't think it's going to get any better. I'll throw out an idea here, and I won't have a bias on it. It's just an outcome that there's no way around. Trump is going to run for president somehow. I don't think the man will retire and look at his portrait on the wall down in Mar-a-Lago and retire. I think he's going to continue to run. Now, either he perceives that the Republican Party could be his vehicle, or he's going to perceive soon that, no, there are too many there that don't like me. I'm going to set up a third party, because he has the power to set up a third party in terms of a base. He's probably got 25 or maybe 30 some odd % of the Republican Party hardcore behind him. And a lot of these are new voters who never voted Republican before, but they got behind Trump and they love the guy, okay? They'll follow him anywhere. If he sets up a MAGA party, they will go with it. Now, if he runs as a Republican, do you think he'll actually win against a Democrat in 2024? First off, there's some Republicans, the old conservative types, the Ronald Reagan and Goldwater types, Republicans who are still around, who don't like Trump. They will refuse to vote for him. So you could take a certain % of the GOP, carve it out. It's not going to vote for Trump if he got the nomination. Call it 20% maybe more. You can't win a national election if you take 20% of that party and have it absent from the voting. They can't possibly win. He can have all his base he wants. He can't win. He won't have the math. If he runs as an independent, then view the Republican side of the equation. They're going to lose 25% of their base that goes to Trump, leaving them with, again, a number that can't win a national election. So I don't see any way around it that the Trumpers are going to be very, very upset as they move toward 2024, realizing what's about to happen. They're not going to win. What are they going to do? Simply say, oh, okay, we're happy. We'll let the Democrat run for another 4 years. No, they're going to do stuff like you're seeing in Brazil. So I think you're headed for that type of outcome in this country that we saw 2 years ago, and we saw the other day in Brazil. And we're seeing it in parts of Europe. Fragmentation. So that's another element that is not being built into the discussion of the outlook for the stock market. What if you end up with that kind of outlook politically? What does it mean for stability, for predictability? It's a big variable. So anyway, all these things exist out there, and I think are going to come coalescing together as this bubble unwinds, the stock market bubble.
So when this thing unwinds, or at least kind of what you're seeing, is it like the bond market collapsing? Is that part of this unwind? Is it the stock market collapsing and bond market? And when that collapses, where's the safe haven, so to speak? Is that precious metals? Is it commodities? Are they both going to benefit? You know, what's your view there?
Well, as our Secretary of Treasury admitted, honestly, a couple of months ago, she said she was very concerned about the, quote, illiquidity in the U.S. government bond market. Mm-hmm. That word is the most dangerous word in market lexicon. Not that something is going down, not that it's going up too much, but it's illiquid. Because when something becomes illiquid, it's not a functioning marketplace. And she used that phrase and expressed great concern about the growing illiquidity in the U.S. government bond market. The central bank can't allow that to happen. So to the extent that she's right, and if that comes back again, and we have again, ongoing illiquidity in that market, therefore greater volatility, less controllability. What's the central bank going to do? Exacerbate it by continuing their current policy? No, they're going to have to somehow find an excuse with a data point or whatever they want to use to begin to shift that policy. Now, if you wait for Powell to tell you they're going to shift the policy from rate rises to flattening to then possibly rate decreases, it'll be way after the fact. The markets will have already anticipated that because they'll see the excuses on the horizon. The markets will. For instance, if you started seeing, well, we're getting massive layoffs in some big companies now. But Amazon just laid off 18,000 people. Well, that, that's almost common nowadays. And when that starts to show up in the unemployment numbers, as it really is, because some of the employment numbers are really quite distorted in favor of what you call more part-time jobs and less important economic jobs.
Right.
But when you start to see data points that the Fed can then point to and say, oh, okay, we've cooled things off. Yes, you have. You've cooled things off. You've hosed down the bubble. The one thing they haven't really cooled off is the commodity markets. If you look at last year, we had the S&P down 20%, NASDAQ down 30%, plus T-bonds down 35%. And what? Bloomberg Commodity Index was up 13% on the year, despite a whole year of rate rises. Yes, it had been pulling back, but it's still up 13% on the year. And gold closed where? Unchanged on the year. Silver closed up 3% on the year, despite, quote, inflation fighting by the Fed. So what the Fed is doing is affecting the markets that they deem to be the critical markets that they need to support. And so a wise investor should anticipate that these events that are going on in the markets, the stock market and the bond market, will ultimately force the Fed, the EU, et cetera, to shift policy back to what they do best, their primary goal, support their government bond markets.
And what ramifications is that going to have to the currencies? Because I mean, basically, they're choosing either the currency or the bond market at that point, right? So if they choose the bond market, which almost all of them decide to choose, I mean, I'm seeing Japan and the gilts, they're also having problems over there. Could this thing domino effect or something happen in the bond market where they panic, they print a bunch of money, and then the currencies just get trashed? Is that kind of an outcome?
The currencies, as we measure them, of course, is a competition between one piece of paper and another. Okay, so think worth no value really and no value really, just a relative valuation. So when we quote the dollar index, for example, it's over 60% comprised of the euro and the yen. Primarily the euro is about, I think the euro is 57% of the dollar index. So it's hardly an index if you really want to talk about it. When one other currency constitutes the majority of the index. If the NASDAQ 100 had 100 stocks, but one of them constituted 50%, it's hardly an index. Okay. Anyway, dollar index, we think, is topped. We think the spike that it had beginning in the spring of last year, it took it from above 103 up to 115 almost. We're now back down to 103. We think that was the top. The question is, on a relative basis to the euro and the yen, can the dollar get trashed? Or a bigger, broader question, will we continue to have a global reserve currency? Where in effect you have a bunch of governments get together and say, okay, this is the reserve currency. It used to be the pound sterling, and now it's the dollar. Or will the world evolve in such a way where there'll be multiple currencies that are all deemed to be worthy of global trade and so forth? And that's already starting to occur. Oil purchases in yuan, so a lot of the major transactions in the world are now shifting away from the dollar monopoly. And I could easily see a situation where it's not just that the dollar is denounced. No, it just has competitors, and where there really is no functional reserve currency. Ultimately, in this game, this time around, we think the standout will be gold, silver, and the gold and silver miners. Now, it's not always the case. Sometimes they'll go up along with the stock market, as we saw, part of the bull market in stocks, gold was going up too. We think now of all the asset class choices that one can make, that the leadership position will be monetary metals, gold and silver primarily, and other metals as well, but the monetary metals especially. And I think last year was sort of a statement about that. Forget the price action, just look at the year-to-date performance in a year in which the Fed bludgeoned inflation, quote unquote, and gold closed unchanged on the year, and silver up 3%, despite the Fed breaking inflation. So I think that's the place to be, because I think that gold knows something. It doesn't wait for events, it anticipates it. Remember, it's the oldest market out there. It'll anticipate what we've been talking about, that the central bank ultimately is going to have to go back to that which they do best, that which they were basically built for, and that is to be undergirding for the government bond market as needed. And it's true in Europe, true in Japan, and so forth. So as that we shift back to that policy, gold will anticipate, more monetary inflation coming, but I'm going to be the prime benefactor this time, not the stock market, because it's unwinding. So that's where I would focus if I were an investor, I would focus almost entirely on that sector. Commodities too, but I think that gold will outpace commodities.
What about the energy sectors? What about like oil, natural gas, uranium, something like that?
They led the first leg up in commodities on a percentage basis. They outperformed, let's say, the Bloomberg Commodity Index. They outperformed the grains. They outperformed certain other commodities, non-energy commodities. Mm-hmm. We don't think energy will lead the second sector. We think it'll participate, but not lead. Our suspicion is, and this is based on technicals primarily, that probably food will lead the next upwave in commodities more so than will energy. Now, our argument was several months ago, once oil got up well past our targets, we turned bullish on oil at $40. Okay, we turned bullish on natural gas just above $2. This is coming up off the 2020 lows in both markets. And then later on, a lot of price chart guys joined in. When natural gas got up to $4 or $5 and oil got up to 80, 90, then they got bullish and bought oil stocks and so forth. At this point, we caution people that this is not a primary place to be initiating a new long position, even though we've had a pullback in oil and natural gas. We think that those markets will linger at high price levels. And by high, I mean, if you look at even the current price of natural gas, which is a sharp sell-off, it's $4. You look at $4 compared to the prior 6-7 years, it's above most of the highs, still, even in the pullback. You look at oil, in the 80s and 90s, compare it to the prior 6-7 years, it's still at a high level. So all they have to do is fiddle around up here, and they're serving an economic function that is choking a lot of things, like corporate profits. And so they're having an impact, even at these levels. But we think that the percent gain going forward is more likely to be in other components of the commodities sector. And I think foods will be one of them. Gold and silver are part of the Bloomberg Commodity Index, and we think they'll lead overall. But they don't actually correlate well to the Bloomberg or to the CRB index. There's quite a few times in history. Well, for example, 2015, gold made its bear low. Low monthly close was 1,060 in December of 2015. Mm-hmm. By the summer of 2020, gold had doubled. Okay. You go late 2015 on the Bloomberg, and the summer of 2020, it was lower than it was in 2015. In fact, Bloomberg didn't explode until late 2020. So commodities didn't even wake up until gold had already doubled. So again, gold does not depend on commodities, quote, inflating. Gold is on its own course. It's a monetary metal. It's looking primarily at the likely trajectory of the central banks. And I think that the deflating bubble that we're seeing in those assets that the central bank cares about will force the central banks back to what they do best. And that's monetary expansion and easy money. And gold, I think, knows that. And that's why it was unchanged on the year.
Okay. So yeah, I know you're choosing the monetary side, that there could be a monetary problem. So the metals like gold and silver. What about platinum? What's your view on platinum, that metal?
Platinum has woken up recently.
Mhm.
Now, if you look at its price chart, it doesn't correlate well to gold over the last couple of years.
Mhm.
While gold exploded, platinum fiddled around, in fact, went down. Platinum is now engaged, and so I think it's in a positive trend now. It's with the commodity package, but it's not a monetary metal. I don't think it'll outpace gold. I think it will follow gold and be a good place to be, but I don't think it's going to outpace gold or silver. I think silver in particular has the potential to be the most dynamic market you've seen in decades in terms of upside gains. It could be the lone standout that people drop their jaw about. It could be what Bitcoin did in 2021, went from 5,000 to 70,000.
Mhm.
I could easily see that type of movement out of silver. And there's some solid technical reasons for that, and there's some relationship reasons for that thought that silver could go to, for example, $200. It's trading in the 20s now. If you want me to get into that, I will. But anyway, I think that the primary focus now should be gold and silver.
I do want to get into it because silver is one of my, part of the channel, we're very commodity and precious metals based and energy based, kind of the whole commodity sector. I would love to hear kind of your reasoning behind why you think silver is just going to go ballistic, because silver is one of my largest holdings, physical silver. So what are the reasons? I mean, you might see it momentum wise. Is there also a fundamental reason why? I'd love to hear it.
Well, I'll stay off the fundamentals. It's a monetary metal. It's the poor man's gold, as they call it. So, okay. So if gold goes up, silver's going to go up. We know that. The question is at what ratio? If you go back and look at gold, start with gold first. Gold, we call gold the mama market. Okay, silver's a baby. It's a wild baby. It goes down more than gold. It goes up more than gold. Since 1970, gold has had 3 bull markets that constituted about 7-fold to 8-fold gains in the price of gold from the bear market low that preceded the bull to the bull market peak. 1970 to 1975 was one of them. It went up almost 7-fold. 1976 to 1980, more than 8-fold. 2000 to 2011, 8-fold. Okay, so 3 times in 5 decades, gold has had a move of about 7 to 8-fold gain from its bear market low to its peak. Okay, so it's not uncommon for gold to produce such a bull market. If there were only one in 50 years, I'd say, well, it's rare, but there were 3 of them. They're almost evenly spaced. So gold has had 8-fold moves before. Well, if we go back to the low it made in 2015, that was $1,050 intra-week, 1,046. So call it 1,050. 8-fold is $8,000. So far high is 2,000 plus. Okay, so gold hasn't even begun to match what it's done 3 times before, and it certainly has rationale this time, monetary crisis type rationale, to go ballistic. And these moves weren't all in the same time frame, by the way. So there's no time sequence similarity. Some of them took a couple years, some of them took 11 years. So there's no clock on this, but it's just 8-fold, 7-fold, 8-fold, 8-fold. We're only doubled. If gold went 8-fold, it would go 8,000. And that would be, we did it a 4th time. Okay, so it's almost routine. We know there's reasons that could cause that. We've already discussed that. Okay, now let's look at silver. If you go back 50 years and you plot silver as a ratio to gold, percent, what price is silver as a percent of the price of gold? You'll see that it's been as high as 6.5% of the price of gold. And multiple times, 4 or 5 times, it's been about 2.5 to 3% the price of gold. So when you plot that ratio chart going back 50 years, you'll see these heartbeats. And they're almost evenly spaced. And you routinely get up well over 2% to 3%. So let's forget the 6.5%. Let's assume it's rarity. Let's just assume, 2.5%. Okay. Going back there on a ratio basis, and right now the technicals of that spread relationship are bullish for silver. It's broken out. We plot that on a month-to-month basis, the silver-gold ratio, and it is technically broken out. So by our momentum metrics, silver's back into a bull mode. This started into September, by the way, this shift. And sure enough, since then, silver's gained a lot more than gold. In fact, it ended up on the year 3%. Gold was unchanged. So that trend is back to positive, and we're only trading at 1.3% silver percent of the price of gold. So it's not up there to 2% or 2.5%. If it routinely went back to, let's say, just 2%, and gold went to another eightfold move, it went to 8,000. Well, you do the math, 2% of 8,000, okay? It's off the page, $160.
Yep.
If it was 2.5%, it'd be $200 or something. So those type of numbers aren't absurd. And also look at the price of silver in itself. You've got two recent highs at 30, but you have two bigger highs at 50. So it's not like it's unusual for silver to go up to $30 to $50. Now, next time around, we suspect it's going to go not only go through the 30, which we expect to see probably in several months, if not sooner, but take out the 50 as well. When you take that out, there's nothing to stop silver. There's no technical price level to stop it. It's just thin air.
Yep.
And it's been there before, routinely, in times where we didn't have the type of background that we have now. So again, the ratio of silver to gold, if it went to some normal level, and if gold went to another bull market eightfold move, then silver could easily be a couple $100. So right now, our main measurements are, one, the momentum trend of silver and gold, which went into corrective mode during the past 2 years, especially last summer, cleansed themselves out, no doubt stopped out most bulls, got everybody thinking gold's no good. Then suddenly, boom, back up again, back well up into that range. We think the major technicals are back fully to positive, and then we're going to take out those highs, the highs we've seen over the last couple of years, and probably soon. And at that point, we think the pace of the advance in silver in particular is going to become more hectic and dramatic. Instead of an incremental bull market, it's going to be more chaos theory, where you're going to have quantum leaps in the price.
Exponential.
As the mama market goes up. Yeah, upside. And I think that type of dimensionality on silver is totally reasonable. And I don't see a way around it, frankly, because I don't think there's a way around the problem that the central banks have created and are going to have to intervene again to try to stop. There's no way around for them.
So here, do you think this bull market is similar to the 70s? Because, I mean, in the 70s, we had increasing interest rates. It kind of broke out and it was in an uptrend for interest rates. We've had this 40-year decline of this disinflationary environment from, early 80s to where we are 2020-ish. We've just broken out on interest rates. I mean, isn't that going to cause a bunch of money to just rotate out of bonds and stocks and seek some alternative investment? I mean, couldn't this bull market even be bigger than, say, the 2000s? Because the 2000s bull market, 2000 to 2008, was in a disinflationary environment with interest rates going down. Now we have interest rates kicking up. I'm like, man, this is going to rotate a bunch of money because you can't be in bonds anymore. Or is the central bank going to come in, buy a bunch of bonds, hold rates down to kind of keep a lid on it, so to speak? Like,
well,
how is that?
As they buy the bonds, they're inflating the money supply.
Yep.
Okay, so they'll engage in monetary expansion. So the weaker and the less liquid, as Yellen termed it, the bond market becomes, the more dangerous it becomes, and therefore the more money has to be fabricated to support that market. Gold will benefit from that. Yep. Yes, I think you're right that people will seek different assets, and I think last year was proof of that. Gold unchanged, silver up 3%, bonds down 35%, stock market down 20 to 30%. So I think it's already begun. And last year, in effect, was a statement to that effect, despite the fact that the Fed said they're going to fight inflation, meaning their narrowly defined inflation, like CPI. They've had inflation. They had huge monetary expansion, free money for a dozen years. That's called inflation. Where did it go? Not into commodities, it went into stocks. Now investors have decided, no, I think I prefer to put it over here. So they create the river flow, but they don't necessarily dictate where the river flow ultimately goes. And right now, I think investors have made that mental shift, saying, I'm not putting my money there again. I'm going somewhere else that feels good. And that would be last year with the energy sector, for example, or commodity-based assets. And I think when it feels good, that's where people go.
Yeah, in the 1970s, we had a kind of a unique situation. We had increasing interest rates. We hit peak oil in 1970, which really hurt the energy side. We'll say, it constrained the energy side. When I look out going forward, I'm just trying to get an opinion here. When I look out going forward, I see the entire world almost looks constrained energy-wise. And if we get the entire world going into an increasing interest rate environment and the bond markets start to kind of, I don't know, crack, so to speak, or people get afraid of it, couldn't we see the entire world kind of run at precious metals at some point? Because last bull market, it was only America, and it was kind of contained to America. We had an American energy problem. We had increasing interest rates, a demographic coming into home buying years, lots of money getting thrown around, inflation and stuff. Could that happen worldwide this time?
Yeah, I think so. I think it is. I think this time we have a global situation, and it will be more exaggerated in certain places than others. A lot of Americans think we're somehow going to escape it. There's one major difference. We have a stock market bubble like we've never seen in the history of the US. Go look at the European markets. Go look at China. Yeah, they went up with the US market. Even China, Shanghai went up, fairly coincident with especially the last several years in the stock market. But there's no bubble. There's no asset bubble to break. Yeah, you can have a bear market if you want, but there's no bubble to break. We had a 16-fold bubble, a 7-fold for the S&P. It's when that beast unwinds, it will have huge ramifications. So that attribute alone, we have a monopoly over. So we have one of the worst things you could have, a bubble, a stock market bubble, whereas a lot of countries in the world, developed countries, don't have that. One that does, by the way, that we're looking at is particularly dangerous is India. India's, quote, emerging, they call it. But when you look at its stock market, it's had a bubble just like the US, and it looks like it's about to break too. So there's another place. But China does not. Europe doesn't look as vulnerable as we do. So I suspect on a spread basis, if one were going to go participate only in stocks, if you short the US and buy China, you'll make money probably. Short US, buy Europe, you'll probably make money. Mm-hmm. So we will have the worst wave effect than a lot of these other countries. So even though a lot of people think, well, we're energy self-sufficient, yeah, this crisis is going to hit the world. And it's going to hit us badly in ways that we don't predict.
And then for the gold market and silver markets, I know I've got a lot of people, they're very interested in investing in certain, ETFs like GDX, GDXJ, and those types of investments and whatnot. Do you think the gold and silver mining companies are going to do well under this period that's coming up? Because if you look at the last bull market, they did very well in the beginning of that bull market from like 2000 to 2004. But after 2004, they basically did nothing. They underperformed the actual metal itself. A lot of the mining companies did in that last bull market. Do you expect the mining companies to outperform this bull market that's coming up? Or do you think they're going to lag a little bit or do well in the beginning half and then lag the back half like the last bull market? What's your opinions there?
Unsure about that, but for now, they're going to outperform. We measure the spread relationship between gold and, for example, GDX. And that spread relationship now favors GDX again. It disfavored GDX since early 2021. No, I'll be sorry, since the summer of 2020, GDX on a relative basis to gold went down more. Gold went into a range, GDX went down. Okay, so the spread relationship disfavored the miners for the past couple of years. But since the summer lows, the mining ETFs measured against gold on a spread basis are now back into outperform mode, just as silver is. Silver shifted back to outperform. So we think silver and the miners will beat gold, though gold is the mama. You have to watch it for major trends. Question is whether during the entire bull market in gold that's coming, will the miners outpace? And I don't know the answer to that. That's why we constantly measure the relationship. And it could be some point in that trend where the trend continues, but the miners deviate and underperform gold. But for now, they've shifted to outperform, and that's just recently. So it's a fresh upturn. So for now, I'd favor the miners. I think I'd favor silver miners over the gold miners, and I'd favor silver over gold. If I had to pick just one thing in my own personal positions, I bought some what you call junk junior miners, silver miners, without even researching them, just handful of them, on the assumption that probably one out of every two or three of them is going to like go up tenfold. Somebody's going to buy them up. They have reality underneath the ground, even if they're not making great profits, but somebody could come in and gobble them up once there's a perception that silver's the place to be. And I'd emphasize silver itself. Now, there's all kinds of vehicles out there, and I can't suggest to an investor what to do because each investor is different net worth, different risk tolerances. There's futures. You can use leverage. You don't have to use leverage with futures. By the way, you can put full cash down if you want. There's options on futures. There's options on ETFs. There's ETFs like SLV or the Sprott Silver Trust. There's all kinds of bullion equivalents investments. You can buy the bullion itself. So there's all kinds of vehicles out there. But I would focus primarily on silver over gold related, and I would focus on silver miners over the gold miners.
And if you were, let's say you could go back at a time, and the time is today, like if you were a 25-year-old today, and you saw this bull market coming like you do right now with all the knowledge and wisdom and experience that you have gained throughout the years, how would you tell your 25-year-old self to play this bull market that's coming? Would you favor physical metals? Would you take and just risk a whole bunch? Would you go on the risky stuff? Would you have a combination spread out? Would you play the big long game? Would you try to trade this market in and out, going in, going out, toe in, toe out? How would you play it?
Probably with long dated call options on SLV, for example. Because if silver has a move of the dimensions, even just the raw unleveraged dimension we're talking about, where silver might go to $100, $200 or something, just to catch up a ratio relationship to gold, and gold continues up, for example. That in itself is meteoric percent gain. But if you're long dated, I mean like a year and a half out, something like that, strike price not too far from the money on SLV. Don't buy something that's going to expire in 2 months. That's silly. We're not trading here. We're trying to catch a major move. That's where I think I'd look if I were a young person, had the money, had the risk tolerance. I think I'd go out and buy call options that are likely to become deep in the money at some point. And so if silver goes up tenfold, they go up 100-fold. So anyway, that's what I would suggest. But again, each investor is different.
Yeah, like a slide out of the money call. Okay, and looking back kind of at some of your, I'll say, extremely profitable trades, how did you set those things up? I mean, like what was the alignment? Did you first look at the sector, nailed the sector, and then nailed the vehicle to play it? Because I know a lot of people, they'll look at the sector, they'll nail the sector, but pick the wrong vehicle. Or what are some of your most profitable trades, and how did you set that up? Was it momentum based? You saw it, you had the three alignments, like it aligned long-term, short-term, mid-term, intermediate term on momentum. You said, man, this is the time to go. And then you played the right vehicle. Is that kind of what happened? Or?
Well, what we do in our reports is we examine gold and silver, primarily long-term trend and also intermediate. Because, for example, coming up off the summer low, the first things to turn back up were intermediate trend metrics, like 3-month average oscillator, 10-week momentum, that kind of thing. And then shortly thereafter, bigger things engaged, like a 40-week momentum, which is like a 3-quarter average or a 200-day average. You blew through structures, not the average itself. That doesn't necessarily matter. It matters whether you have a clear momentum structure you're breaking through. And those all occurred coming up off September and October. So several months ago at much lower prices. But then when we go to the miners, while we favor miners in general over gold, for example, on a ratio basis, we think they'll outperform them. You can go within the mining sector, and this is true with any sector of the stock market. We all know that. You go in the tech sector, there's some that are outperforming other tech stocks, the bank sector, so forth and so on. We do our own micro analysis within the sectors. And so every month we come up with a report that's called a SIFT report, where we've gone through GDX, SIL, and looked at their holdings and measured the individual symbols in their relationship to that ETF. So how well is this gold miner doing versus the group, the GDX, on a ratio basis. We plot the spread. And obviously, in any given market, at any given time, there will be some stocks within the sector that are beating the sector, some that are on par with the sector, and some that are underperforming. And so we like to try to pick ones that are outperforming. And we measure them via the spread. How are they doing versus GDX? And so you can have a gold miner, for example, even in the downturn we saw over the last couple of years, where there might be a given miner that's going down, but it's going down less than GDX. So you'd rather be there than in GDX. So we do that as well. I can't say we always pick them, the right ones. Sometimes we miss some outperformers. Mm-hmm. But generally, that's the way we look at it, is we look at the individual miner versus the sector and measure the spread relationship. And those things change. I mean, in the first half of the bull market, you might have one miner leading, and then suddenly in the latter half, that miner is a laggard. Mm-hmm. So it's a continual process of assessment.
And then kind of my last question, at least, what does an exit look like? I mean, is it basically the entrance just flipped upside down with momentum? Yep. I mean, is that kind of what it is? Yep. Or is there anything else that you're looking at? Is it ratio based? Is it anything like that?
Yeah, sometimes when you've got some good profits, let's say, especially, you want to protect them. So you don't want to give back much. Fortunately, momentum will generally top fairly soon after a market's actually made its price peak. Not a year later, but a couple of months later. Mm-hmm. Like we turned major bearish on gold in January 2012. It was 2 months after its high. It occurred in 2011 because annual momentum broke down. But sometimes we get a warning prior to the downside breakage. We'll get a warning from momentum that it's excessive, and we use standard deviation measurements. Like you see these Bollinger Bands on price charts, the upper and lower bands. Mm-hmm. We do similar type work, but with momentum. And certain juxtapositions of those bands will tell us that a given market is overbought or oversold. And on what time scale? I mean, to be short-term overbought is one thing. To be overbought on a monthly momentum, that's a little more important. You pay more attention to the potential for a downdraft. Then the next question is, if the market's overbought, let's say it's a nice big bull trend and you're in it, and you're looking to take profits, you can wait for the breakage, or you can wait for an overbought signal and see the pending breakage. In other words, if you can see something that could be broken soon below you, and it won't take much, let's say, and you've got an overbought market, then you've got two warning flags there. One is saying this is overbought, it's likely to stall and turn down somewhat, but it can't afford to turn down because it's got a structure pending. Mm-hmm. That would be a time where you actually maybe exit your position before the actual downturn is fully signaled. Did you follow that? Okay. So,
yeah. So
sometimes there's a
what you could have, and so silver is like incredibly volatile. It rips up. You'll get a big wick at the top or something like that, where it comes up, trades back, intraday, just gets smoked to the downside. Mm-hmm. I'm guessing that's your momentum there. Then you can see that, and it's probably at an overbought level. You've got a real cheap ratio where silver's outperformed gold for a year or two or something. Maybe it's down at 30 or something like that, or 20. And you're looking at it like, I'm going to exit this position, and you just get this blow off kind of top and then a big sell off with a big wick. And mm-hmm. I'm just trying to see if how you would approach that from your standpoint, because silver is like one day it could be 55 or 150 or whatever the price is at that time, and then the next day it's down $10, or did it intraday.
Yeah.
That's what I'm trying to.
Well, yeah, we try to look for things that might clue you on that, and that would be one of them. The momentum exhibiting excess readings, and that's objectively definable. For example, our lower standard deviation band of, let's say, monthly momentum, if it rose above the zero line on the oscillator, that's an overbought signal.
Yep.
And the opposite can occur if the upper band drops below the zero line. You have to see those charts to understand. It's strictly momentum; it's not on price.
Yes. So you're taking an average, and you're looking at the difference between the price level and the average, and you're plotting that difference basically. And then you're seeing when it goes way overbought, when it becomes extended above your moving average, you're saying, okay, that's way up there. Right. Maybe it's time to pop out.
Yeah.
So
sometimes momentum will create certain repetitive ceilings that are very high. For example, during the S&P, during the Nasdaq's bull market of the past dozen years, from 2009 to 2021, there were like 3 or 4 times where the Nasdaq would get 40% over, just a bit like 41, 42% over its 36-month average, and it would fall back. And most of those pullbacks were benign, meaning the market simply paused and pulled back a little bit, and they were corrections within the bull trend. But it'd do it repeatedly, 40-something% over, 40-something. In the blow-off phase, when Nasdaq went berserk, late 2020, early 2021, it blew through that ceiling. So you got up to that overbought level again, and this time said, I'm not stopping here. And you went berserk, and you stayed above that level for a year. It's when it closed back down below that old ceiling, which was a structure.
Gotcha.
It's like an elevator going through the top of the building. Okay, it fell back down. When it fell back through that ceiling, the close of January last year, we said, that's it, it's over. Off top is complete, you're going down. And sure enough, Nasdaq then was just below 15,000.
I got it. So I know how you're doing it then.
Yep. Yeah. So yeah, there's times you can get those kind of clues from the momentum action. Yeah.
Okay. Well, do you have anything else that you'd like to share? I mean, anything that like final comments or anything like that? Anything in general?
No, we've got some numbers on gold that I would call our final layered trigger numbers. We don't usually just come up with one magic number that says, okay, it's a bull, it's a bear. When you measure a market on different time scales, you'll have often different layers on momentum that say, okay, this just broke out on intermediate time scale. Oh, this just broke out on a long term. And it might be different in terms of where the price is at that point in time. Well, silver and gold have both come up through lots of structures, breakout structures, over the last couple of months. There's one remaining one in gold. Again, the mama market. And as gold goes, ultimately silver, even though it whiplashes, as you've noted, silver will follow and lead. And last week, the number was a weekly close at 1870. So what did Feb Gold, which is the front month active contract, do last week? It got up to 1871, I think, on Tuesday, sold off all the way back down to 1820s, came all the way back up, I think, on Thursday, got up to 1875 and change, and then came back down, and the settlement price Friday was 1869.7, 30 cents below our trigger number. Okay, so it didn't break out of this, what we call a final buy signal. It's not the first, it's the, we'd say, if you haven't added, just point to add. This week, that number adjusts up about $3. So you need to close the week out at 1873. I think we're trading at and above that right now, but it's not Friday. So close out Friday, 1873 or higher, and gold pushes itself up through yet another structure, and I'd call that the quote final structure. Now, when you look at a price chart, what's obvious is you got 2 peaks up there at 2070. So the price guys think, well, I got to go through 2070 to make this good. We'd say you close 1873 this week, this Friday, and you're probably going through those 2070 highs. There'll be a price breakout, lag to the momentum signal. So anyway, that's our final number. And obviously, if you see that, that's going to be positive for silver as well, regardless where silver might be trading at that point in time.
That's perfect. 1873. That's the line in the sand.
That'll adjust up $3 a week. You get that for free.
Awesome. All right. Well, that's all I've got. Michael, that's great. I'm glad that you came on and shared all that information. Lots of valuable information there. And thanks for answering a lot of my questions too. How can people reach out to you? Do you want anybody to reach out to you, or do they want to, if they were to want to talk to you or something?
Our website is Oliver MSA from Momentum Structural Analysis, olivermsa.com. You go there, and there's different categories. One's deals with our method. It explains, what is our method? Why is it different? We've got some old archival reports. We've got some endorsements. Wall Street Journal did an article on us in late 2015, just on us and our method. And there's a summary sentence there about how they view our method. And if you want some recent samples under my picture there, my lovely picture, is my email address, Michael Oliver at Oliver MSA. Click on it and request, and I'll send you some sample reports, some recent sample reports. We cover all four major asset categories: equity markets, bond markets, foreign exchange, and commodities. Oliver MSA.
I'll put that in the description link, everyone. So thank you for coming on. I really appreciate it. And thanks, guys, if you made it to the end, good job. We'll catch you next time.
Thank
This
you.
is Finding Value.
Fun.
Yep.